Good afternoon. I have the privilege of moderating today's session, which is actually the easiest job of any session. So I think what I would do before I get into the topic per se, which is a bit of a negatively worded topic because it used the word disguise. It seems that Ps are disguising as VCs, and we're going to discuss that, what that really means. Having said that, I'll probably request each one of the panelists here, Samir, Pramod, John, and Shashwat to very quickly introduce their firms and themselves. As far as I'm concerned, I am one of the managing partners of a lower mid-market private equity firm called ASK Pravi. We invest in primarily private equity situations, not in VC situations yet. So in some sense, we're not in that overlap. But that's so much about myself, but I'll probably request Samir to start from that end.
I'm Samir Nath, managing partner of Iron Pillar, which is actually relevant in the sense that we are aiming to be sort of India's first venture growth fund focused on the mid-stage, which Jayanta just talked about. So really Series B, C, and D investments, and we'll definitely talk about that as the panel discussion goes on.
Sure. Thanks, Jayanta. My name is Pramod Ahuja. I'm a partner at the Tata Capital Growth Fund. Tata Capital, as you know, is sponsored by Tata Sons. We've been in business for about 7 years, completely invested Fund 1 across three themes, as we call them: urbanization, discrete manufacturing, and strategic services. 9 companies performing and tracking as per expectations. And it's typical PE growth where we have the ability to bring all of the synergies that the Tata Group has to offer.
I'm John Dougery. I'm one of the partners at Inventus Capital. We're an early stage venture capital firm. We focus on primarily Series A lead investments. We've been doing that here between Silicon Valley and India for the last 10 years. We have over 40 companies and over 2 funds, over 150 under management at this point.
I'm Shashwat Sharma, and I'm a partner with KPMG. At KPMG, we've been doing a lot of work with, in fact, a lot of the parts of the ecosystem, right from helping some of the funds, such as those on the stage, think through their investment thesis, help them find the right kind of opportunities, but also more importantly, on the consulting side, we work with a lot of players in the industry and really work on their business models, their technology systems. So it's a whole host of services we offer. So happy to be on the panel. Thanks.
Thanks, everybody. So I think let us start this by asking John here, who's focused only on VC investment. Does John really think that the private equity funds are taking a share out of your business, or is it like more the merrier? What is your view coming from a pure VC standpoint?
Sure. Well, I don't see that private equity funds are taking a bite out of the Series A business where we focus, but we are seeing an increasing trend where more the traditional growth PE players in India are, expressing a lot more interest in our companies that are at more mature stages than they did in the past. I think the hedge funds have largely cleared the way for them to do that, and I think, frankly, the portfolio companies are getting to a stage where they meet some of the criteria that later stage or growth PE investors are used to looking for, and can take the kind of the check size and the capital and put it to work usefully. So we're seeing that more. At least in terms of the early stages of discussions. I don't know if we've yet seen a lot of closes yet of investments, but there's certainly a lot more interest at this point from our perspective.
Pramod, you're on the other hand a private equity fund which probably also does a few deals which can be considered to be VC-ish. Are you looking upon this as a strategy, or is it that you're reacting to opportunities that come your way? First of all, do you even agree that private equity funds are actually disguising themselves as new VC players?
No, I think this is an evolution and everyone has a role to play. So our role is quite well defined. We want to provide growth capital, minority stakes in companies that have the ability to scale maybe 3 times in 5 years during what is our holding period. So we are kind of growth agnostic. We'll fund early stage growth, late stage growth, mid stage growth. The idea really being is to identify maybe macro trends and then overlay that with good micro, because in minority investing, you've got to get the partner really right because you're a minority and they're majority. So one, I don't think we're disguising to be VC, but I think the whole evolution is taking place in such a way that there's fertile ground for everybody to play in. And in some sense, we are complementary to people like John who bring up a company to a certain stage, and then we hold it for 5 and 6 years and then pass it to the big bulge bracket private equity funds. So as I said, there's an evolution and we play our small little role in that evolution. But it's, there are more instances of maybe private equity, so-called traditional private equity funds dabbling in slightly earlier stage companies. And then again, I guess they need to have the risk reward kind of commensurate with the, well, the reward needs to be commensurate with the risk that they are taking. So there are many factors that go into it, Jayanta. You know, another, criteria that one needs to consider is really what is your hold period? How much runway do you have left in your fund? If you want to make an early stage investment, do you have the ability to hold on for 5 or 6 years? So there are lots of compulsions that eventually go into making some kind of VCPE blurred investment decision, but I think it's complementary. It's not them versus us. So it's just a life cycle evolution.
I think that's two interesting points you made. One was about, usage of the word dabbling. And the second thing, I will come back to you later probably during the discussion about this, the time left for the investment period. I mean, that to my mind could be a very significant factor in deciding the kind of investments a fund will be doing. End of the day, we are all limited life structures. But coming to you, Samir, you are actually raising a fund based on a very interesting strategy, which is not necessarily Series A VC, but like you said, Series B, C, D VCs. So at the same time, you don't really necessarily call yourself a VC fund. You probably call yourself a venture growth fund. So I mean, how do you see? Because one of the things which we need to discuss today is that the overlap that we are seeing, whether it is a one-off overlap or opportunistic overlap, or is there a structural change happening in this whole continuum of VC to P? And you seem to be kind of raising a fund bang on that strategy itself. So it'll be very interesting for the audience to hear your views as to how do you see this continuum and changing.
Sure, happy to, and I'll try and not lapse into my whole LP pitch. No, but I'd like to pick up from what Pramod just said. I think certainly in the market today, we see the gap, and therefore we see the opportunity. But I think what we are trying to build is something that is well beyond sort of this particular window of opportunity. And the way we're thinking about it is obviously capital to address a gap. But much more than that. So the value add that we're trying to bring from the composition of the team, from networks in China, which we think have historically not been as strong as, let's say, Silicon Valley. And obviously John and his team are part of the pioneers of bringing that model here. So I think what Pramod said is something I would agree with, is that this is an evolution. And I think I would say that where the market is today, just to rewind back, and the previous panel touched on this as well, we saw a bubble that was just 5 quarters, right? From sort of second or third quarter of 2014 to the third quarter of 15. You saw, I guess, investors of all sorts during those 5 quarters of bubble, and you saw hedge funds, you saw a bunch of opportunistic investors dabbling in venture growth, shall we say. And since the fourth quarter of 2015, you've actually seen very few of those opportunistic investors still stay active in the market. So it's interesting that just when the Series A funnel is at its strongest, both in quality and quantity, you actually see this capital crunch. So we don't think that it'll last, as Pramod said, for forever. There will certainly be new entrants, and there will certainly be people who will adapt their strategies, but we definitely see a good runway of opportunity now where sort of the supply-demand equation in that space is very much in the investor's favor.
Right. So in the US or more developed markets, you find that companies raising Series A, B, C, and so on and so forth from primarily VC players. And like you said just now, that there seem to be a lot of opportunities, funnel, as well as investors in the series at the Series A level. But later on, it seems to be dwindling, that amount of capital available. In this context, and there is an opportunity space created right now. So do you see, and maybe, Shashwat, you can also come in here, but maybe Samir can start off. Do you see this gap being addressed by a new class of investors such as yourselves, or do you see that the VC is coming back and doing more later stage, when I say later stage, the VC context investing, or are you seeing private equity funds coming in and filling this gap? I mean, who do you see really filling this vacuum?
So we certainly believe that there is room for a few more funds like ours where we sit today. You probably couldn't make a compelling case for that a few years ago when this funnel wasn't as deep and as high quality. Part of the reason for that is, we're a first-time fund. We're only going to do 12 to 15 deals. And if you look at the Series A funnel, I think the last stats I saw, it was something like 290 companies that got Series A funding just in 2016. So that's, and then if you sort of take that over a 3-year period, which is the funnel that's available, that's a large number of deals. I do see the larger Series A VCs starting to do a few more Bs, and maybe they'll do a few more Cs as well. Shashwat, if you have more data on that.
Yeah, no, thanks. I think if you just take a step back and really see where we are in the current economic cycle at the country level, because obviously a lot of these transactions, a lot of these deals will be driven by where we are and at an overall economy level. So we have sustained growth in the economy, but obviously in any growth economy, certain industries and certain sectors have a lot more opportunity than others. So if you see in that perspective, and there have been a lot of transactions, I'm sure all of us have been tracking in terms of how many transactions happened last year, estimated about 1,400. But if you really look at number of transactions above 50 million, they're actually less than around 45. Now, really the point is, and if you look at some of the industries where these investments are actually going in, so the primary industries which we see are around the new age technology. So be it around some of the models evolving on fintech, but also more importantly, some of the services companies, some of the new technology evolving. So for example, if you look at companies focusing on analytics, distributed ledgers, trying to see how the tech world would really move and go to the next level of embedded devices or IoTs or blockchain. So these are the kind of things which are really happening. Also, if you see from a financial services perspective, while some of the still larger deals, if you look at overall landscape, we saw a lot of things happening in the small finance space. We also see, obviously on the debt capital markets, we saw a big IPO coming in. But really speaking, the small finance bank or the payment bank were one-off. Obviously, for the next 2 or 3 years, we don't see too much happening there because regulatory, that's the nature of the beast. So over the next few years, that we really need to be aware of in terms of what parts of the economy would be really firing, where would you see opportunities. So areas around financial services which are more technology driven, e-commerce, and obviously the number of deals has dipped quite significantly if you see over the last couple of years, but still, I was hearing very interesting things in the room in terms of how are traditional business models going online. And that's really been the case. So when I go back in my career 20 years and when I started off in the world of consulting in the mid-90s, that time we used to call it .com. Now obviously we found different words for them, but pretty much disruptive business models on traditional businesses. And we used to always say, and this is obviously the mid-90s, we used to say, Yahoo is just the new Yellow Pages. Now obviously, who says that anymore? But a lot of traditional business models coming, being disrupted, that's where we see in the next few years there would be traction. And also on the consumption side, on the food side, what will be new models emerging? So I think really the point is, to the point being made by the panelists, it's very important in the overall investment thesis in terms of where we see the macro picture, where we see different companies playing, and then depending on what is really the need, obviously risk capital versus growth capital, we can have that debate, but also I think there might be areas where there must be co-investments? We've seen a few transactions last year, but can these different funds with different theses really co-invest? Because you can argue that a PE will invest in a mature business model which has a steady revenue stream and a EBITDA which is positive, whereas a VC takes higher risk. But then is there some sustainable model emerging where these worlds could converge? I think that's something for us to think through.
Pramod, I was about to ask you, I mean, Shashwat, I can understand all these trends, etc. But, you, as a fund which has done these kind of overlap deals, would you want us to kind of give us a little flavor of the thought process which was there in the firm when you did some of these deals were not necessarily pure private equity?
No, so I'll answer that in a minute, and all our deals are pure private equity for the most part. But I was just thinking a few years ago, Jayanta, there used to be VC, PE, and buyout. Now we've kind of gotten lost in this alphabet soup of A, B, C, and stuff. So maybe it's a sign of maturity, consolidation, and maybe opportunities for certain sectors that are not catered to. So from our perspective, Jayanta, what we did is, for example, in the case of affordable housing mortgages, 3 or 4 years ago, we looked at a certain company that we invested in, and we said the opportunity is so massive, the macro is so compelling, there's such low levels of penetration in mortgage, and if you take it down to sub 15 and 20 lakhs, the penetration is even more stark. Does it make sense to do a pure growth investment with slightly earlier than we would generally have liked? And then again, as I said, there are too many factors that come into play, and investing is an art. So then you take a macro call, and then the micro, the management teams, the promoters, in that specific case, had proven themselves many times over in consumer finance and built up something that we could put as pure track record. And so we made those investments. So as I said, we remain growth agnostic, and in the case of housing finance, in the case of insurance, I don't know what alphabet you want to put onto them, C, D, E, or F, but there were opportunities there because again, insurance, microfinance, housing, the macro and the penetration the macro is large and the penetration is very low, that it kind of made sense to make these kinds of investments.
Yeah, actually, following up on what you just said, and maybe I'll request John to share with us his thoughts. See, as I'm hearing all of you talk, a question which is coming up in my mind is that, is there a difference between VC investing and, startup investing? For example, if we were to start another bank today, pulling out a management team from, a top-level bank, and then, 2 later stage private equity players come in and invest for the first time to capitalize the bank, would it be considered as a VC investment? I mean, there is a world of difference between starting a fintech or a retail app and starting a business. Not necessarily, startups are not necessarily VCs in nature. So I just thought, if you could share your thoughts on how to look upon these kind of situations.
Yeah, I think you bring up a good point because, the area we play in is all around technology venture. But that doesn't mean that's the only interesting area to start new companies. And financial services, infrastructure, all these other areas, the new companies are coming up, whether it's energy, what have you. And yeah, I think the startup mode there, even when we started 10 years ago here, what really struck us coming from a Silicon Valley point of view is that how mature the companies were at a Series A stage. That they had bootstrapped to something meaningful in terms of proof points of the business, of the technology, of the product. And, Pramod, your story, it sounds like you might have had a few of those elements in this investment you made in housing finance. We had a great team that had kind of taken it down the road a bit without a lot of outside capital, but it was ready then, and it was a bet worth making on that. And that's, in many ways, very, very venture-like. But, the risks you're taking, the technology risk or the market risk that you generally see in technology investing is very high. In what Pramod described sounded much, the market was clearly there, right? You're not inventing something new, hoping that everybody suddenly becomes a social media, participant, 15 years ago. You don't have to make that bet, right? You knew they needed finance for their homes. So I think there's a segment of growth equity that's always played that game where, family businesses or, businesses that haven't taken outside capital for even generations or years now are ready for it. But I think that's not venture in the sense of technology venture anyway.
Right. So it is very important, I think, for all of us to acknowledge here there's a difference between, types of companies at which stage. Now, the stage is not the only differentiator. Right. Just because a company is 6 months old, the risk reward, the profile, the evaluation is very different from, say, a pure tech company to compare to, I could do why a bank? I could do a startup, say, apparel brand. Very, very different dynamics. And a private equity firm traditionally comes in and invests, into a company which is into, say, a warehousing company, which is 2 years into its inception, does not necessarily have the same characteristics as investing in a food delivery app. Very, very different. So I think these are the nuances which, of course, behind the headlines, beyond the headlines, these are the things which we need to kind of think through and probably acknowledge before we make kind of conclusions that the P and VC boundaries are blurring. So I think what I'm hearing here from all of you is that this concept of blurring of the boundaries have to be looked upon in the context and keeping that perspective. So it's not as simple as it sounds to be. It's not that suddenly VCs are doing, or the Ps are doing VC deals.
And just, Jayanta, just on that, and I'm just building off what John said, I think you're right. The lines are blurred, and there is a little bit of an alphabet soup, which is just one person's nomenclature could be something else for the other person. But I think more importantly in India, what you're seeing is that there is that evolution and maturation of the landscape, right? And so 2 of our founding partners are from sort of US and China. I've spent the last several years investing there. And there are no sort of liquidity gaps in those landscapes. And so I think now that you find some of these niche strategies coming into play, mostly first-time funds, mostly homegrown funds, I think that's sort of part of the evolution where you then have that pipeline all the way from sort of angel to seed funds to Series A, and then getting into your sort of late stage. And so I think that's what we see as sort of the evolution or maturation of the landscape.
Changing tack a little bit, we've been all talking about making the investments. A very important part of this whole piece of the puzzle are the LPs. And unfortunately, we don't have an LP on the panel here this afternoon. But maybe I can start, with John because he's been raising money, and then all of you, since you've been interacting with LPs. What are the LPs thinking? Are they really thinking in these terms, or are they really evaluating team by team, strategy by strategy, and they're not really trying to box anybody as a VC or a P or an overlap or venture growth or what have you? John?
Yeah, I'm happy to start there. Most of the LPs we talk to say that they'd like to do the diversification, don't do it for us. So, we're investing in you to do early stage venture. We don't expect a lot of thesis drift, as they call it. We want to see that some very high percentage, 90% or more of what you do is what you've promised to do. So I imagine that that's what they're expecting from all their different managers to some extent. And it's interesting, we've had a lot of the big global PE players coming to us every quarter, every month, kind of tracking our portfolio because they're starting to see, I think it was mentioned by Samir that the maturity in the portfolio is becoming something that is attractive to private equity. It's not that private equity is trying to mask themselves as a venture firm. It's that these companies are now starting to graduate. And they're starting to graduate to a state where they have cash flow. They have a predictable business. They're in a leadership position that looks quite 10x the nearest competitor. So you don't have the kind of existence risk and that would be anathema to somebody that is looking to invest at that stage. So I think that's the maturity, as you point out, of the pipeline that's been built over the last 10 years of venture investments, that now some of these companies are real companies. And they need the growth capital, they need the operating experience, and I think the LPs, they'd be very welcoming of that if that were the case, right? That's the investment thesis that the growth player is making. But I'm speaking from the venture point of view.
Sure. I'd like to make a point, I think, to build on what John said. I think, so our experience has been that all the LPs, like John rightly said, have an investment thesis. And when they look at a market, they obviously look at different fund managers for doing different things. Now, and obviously they agree with the fund manager in terms of what they expect them to do in that market. Now, if almost, so on part of their risk diversification, so if the same LP is entering into a market like India through, I mean, we have heard all the alphabets from A to whatever, we haven't reached Z yet, but whatever A to where we've reached. Now, if almost all the fund managers start doing something similar, then the LP might have a risk of concentration. So I think while these boundaries are getting blurred, a lot will depend on what the thesis of the LP is and how they view the markets and how they view different vehicles trying to look at an overall thesis view. So in case all the investments start panning out on a very similar strategy, then I would assume, and that's our experience, that some of the LPs would get anxious.
Sameer, what are you hearing when you're doing your pitches?
So I think the guys who've actually raised the funds should speak, but no, this is an interesting learning experience as we are out on the road fundraising. I think for the most part, LPs who have spent time in India venture understand the quality of the Series A funnel that has been built and are increasingly aware of this sort of capital crunch. So I don't think we've had to struggle to explain that part. Then the next thing that follows obviously is what is the right strategy and you know who should actually sort of take advantage of that opportunity and fill that gap. But the fact that there is that structural gap, I don't think there's been sort of any pushback. So I think then the question is, as I think John said, is that thesis, is this a highly opportunistic one fund kind of thesis, or is there something really sustainable to build on and say, okay, this is how we're starting, but we're actually going to look to do this, and that is a much more sustainable proposition than taking advantage of a near-term market window.
I have a bit of a follow-up question on that. You know, there is really no dearth of capital in the world, right? So why is this gap, you know, we've had obviously very, very well-known firms coming in, hedge funds coming in and doing big Series A deals, and they seem to have really taken a step back. But is there a stepping back or reduction in availability of capital in the, you know, these VC situations? It's because the situations are not that attractive, because otherwise why would there be a capital, a lack of capital? There is really no lack of dry powder capital of across the board, anywhere in the world, by and large, more or less. So why is this happening? I mean, I'm seeing it from the other perspective. I mean, if I had raised a private equity fund, which I would do, say, $30 million and above, and why would I necessarily want to come in and do a $7-10 million VC-ish deal? And what is really driving this? Is it the opportunity set which is presenting me? Because, or is it that I've raised too much of capital and I don't find enough opportunities to invest? So these are all kind of typical LP questions, but maybe all of you can throw in your perspective. That will be helpful.
I think John summed it up perfectly when he talked about VCs and from an LP perspective, because what they really dislike is thesis drift or strategy diversification. And I think the fundamental assumption is that they're becoming a lot more discerning. So even in our world, PE world, to say you're sector agnostic really means nothing. What does that mean, right? Tell us what sectors you're going to invest in, how are you going to invest, and what are you going to do with those companies? What value are you going to add? So they're becoming a lot more discerning. They can see through stuff. And what they really dislike is mid-course correction. So you suddenly say that, you're this type of an animal, and midway you realize actually you're not, you're better off me doing something else. Chances are you may not raise another fund if you adopt such a strategy drift, as it's called. So I think they're becoming discerning. They want you to deploy the money for which you raised and for the purposes that you raised. And to be honest, in our world, they're not looking to, they've underwritten an investment of 2.5 to 3 times MOIC. They don't want this high loss ratio, suddenly 3 companies going bust and 1 company returning 10 times. They don't want their returns to be concentrated. They want it diversified. So I think there's a clear bucket for everything, and you just have to enunciate what your strategy is and stick to it. And if you do that successfully, then you'll raise multiple funds.
Yeah, I think it's a good question, because when I look at it from the Silicon Valley perspective, there is no dearth of capital, right? Everybody that wants to invest, every asset class, every stage, every piece of the alphabet is covered. And I think that, one of the themes of this conference has been about, limited partners, fund formation, access to capital, and India's access to capital. And I think that there are some structural impediments here that are not as easily overcome. And there's plenty of, we try to take our companies to many of the growth, the venture growth players we know in Silicon Valley, and they're quite compelled by the companies, they're quite compelled by the businesses, they like the teams. But when we tell them the management team is resident in Bangalore, they necessarily pass because they need to be, there's still enough company building to be done and value add to give, and they can't give it from there. And they don't have a Mauritius structure, they don't have the feet on the ground here. So unless they're a global platform, they're not able to bring that capital to bear in India. And so I do think there is a bit of an air pocket here where there's this evolution of the ecosystem. We've got over 1,000 companies that are beyond the Series A stage, many of which that have earned the right to Series B and C and are great investment opportunities. And we're seeing a lot of internal rounds in the venture community to cover that gap. And that's of your own companies. Again, not doing thesis drift, you're supporting your winners and you're battling through. And I think that it makes sense to me that, Samir, you should have an easy time selling this because, there's the IVPs. There's a great proof point in Silicon Valley of the mid-stage venture community that has made a ton of money for their investors and is doing it on a consistent basis, year after year. And I think that India's on the crest of that. There's 1,000 companies. There's not just a couple hundred to choose from. And there's just being more and more and more started because the Series A and the seed and angel community is quite robust. And so I don't think that's going away. I don't think it's a one-hit wonder that's just a temporary problem. Yeah. I think it's something that needs to develop just like anything else in an ecosystem.
Yeah, I just, one more point on this one. If you see, at the moment you apply the risk-adjusted return of capital, and then you add the India country risk, and then you talk about some of the other structural issues, and you talk about a lot of also the regulatory aspects, suddenly you are talking about very high returns. Because, we just look at India's rating, the risk-adjusted returns, suddenly, so the moment we are expecting very high returns from the Indian entrepreneurs or late-stage investments or the companies, there are very few business models which are of scale, which can give that kind of return on a sustained basis. So if you see in terms of, if you look at the investments and the top 5 sectors which have attracted the PE and the VC investments over the last 10 years, top 5 continues to remain around technology, around financial services, and around consumption. So if you see these 3 sectors, now how many models are there which can really give that really high return, which would meet the expectations after you look at the India country risk? So we heard about financial services from Pramod. Now if you see even housing finance or some of the other industries, for the kind of the price to book multiples which we are looking at, are they going to be really sustainable over a long period of time? Would it continue to attract the kind of investment? Life insurance sector, it's already over-penetrated in India for the kind of offerings which the companies have. Obviously, a pure risk is not there in the Indian market. Just a pure risk-based insurance company. The kind of product which we have in India, they are already 30% penetrated for life insurance. So is that going to be sustainable for 10 or 15 deals? Maybe not. Maybe 2 or 3 companies which have very strong distribution? Absolutely yes. So I think the moment we apply some of these lenses of return versus risk, the number of transactions and the number of opportunities become limited. And then we can argue whether it's a PE opportunity or VC opportunity, but the stock of opportunities itself will be limited the moment we apply these lenses.
I think we are almost just a few minutes left for the panel to go. One question I wanted to ask each one of you, Sameer, Pramod, and John, is that is there a real difference in skill sets in evaluating and making these investments if they're really to be bucketed as P and VC? Or is it all just nomenclature and an investor is an investor?
So maybe I'll take a stab at that. I wouldn't say dramatically different, but there's definitely a few subtle things. Part of it is skill set, part of it is strategy related. So for example, a big part of the early stage model is diversification and slightly larger portfolios. And again, maybe I'll speak from experience. What we have thought is we assembled our founding team, the 6 of us. So there's 2 of us who have the venture tech investing experience. We took a slightly different approach and said that one of the big things that we wanted to demonstrate was liquidity and cash exits, where we think technology has had a good run in India. So there's actually 2 of us who have spent 15 years doing technology M&A in the US and India off that 6-person team. We decided to have an operating partner, which you could say in some cases has parallels in early stage, but then also has models in private equity where it is really roll up your sleeves and actually help the companies post-investment with fairly active hands-on support. So that's the way we thought about it in terms of sort of mapping the skill sets with the opportunity and sort of trying to assemble the team which had the relevant strengths and experiences. And the other thing obviously is both US, India, and China experience combined with those skill sets.
Sure. I guess the underlying requirement is across different asset classes, you have to be an investor, period. If you don't have an investment mindset, then you shouldn't be investing. But there are some differences on the margin. For example, in VC, early stage, sector knowledge, deep insights, that comes to bear on your investment strategy. And again, without sounding controversial, PE guys, you have a lot more attention to detail might be pushing it, but there's a lot more, for example, going through diligence reports, accounting diligence, financial diligence, commercial diligence, legal diligence. So I think you have to be more diligent. You need to have an eye for the minute details as well as the big picture. But maybe in VC investing, you can get away with having certain ideas and big picture in mind, and then making investments and then watching them grow. So I think on the margin there is some difference, but the core requirement is an investment mindset. John?
Oh, I think not a controversial statement at all. I think that we talk about this in our own partnership. When you're investing in an early stage company, there isn't much to know. What you have to know are these soft skills, the team, the market, the general macro stuff. When it gets even to Series B, C, D, and we have to decide how heavy do we want to follow on. Do we want to triple down here? Then there's a lot to know, right? There's lots to diligence, lots to understand, and if you miss it, well, shame on you, right? And so then you do have to get into the financials, because now it's a running company. It's got all those elements. So it's a very, very different investment model, I think, and I think it takes a very different set of expertise. And you can stretch to Series B or C, but at some point, when these companies graduate, they need a different method.
Thank you very much, each one of you, Sameer, Pramod, John, Shashwat. And thank you very much for bearing with us.